Hi everyone, today I'm here to share more about what is financial planning. So ever since I've become a financial services consultant, many people have asked me what do I do on a day-to-day basis, what's my job, and then what exactly is financial planning. So I'm here to answer all your questions. So financial planning is actually very simple. It just means you are planning for all things in life that is related to finance. Okay, so how do you plan for all things in life that is related to finance? You need to look at how one life is usually like. So move on to usual life. Okay, so this is what life is about. You start as a kid, then you go to university, then you start working, then after you get married, have a house, kids or car. So sometimes people don't have the merits, but most people have the house and the car. Yeah. Then after that, you go into like retirement. After retirement, if you have kids, then you think about legacy planning. So even if you don't have kids, you still need to think about legacy planning because you need to think about who you want to leave your money to, that kind of thing. Yeah. So this is what life is usually like. So in life, what are you usually working so hard for? You need to ask yourself that question lah. Yep. So these are the stages and what they require. So I'll go more in depth into all these things in the next few slides. Yep. Okay, so if you're a toddler, you're a teen, your expenses are usually taken care of by your parents. So you are like stress-free and stuff. But for your parents, they do need to do the planning. So as a kid, you are usually quite exploratory and can easily get into accidents. So when I was young, I actually go and climb a window and then I fell and I almost went blind. So there's like a scar above my eye here, but you can't really see it. So it's like so near my eye that I could have easily been blind. So I'm so thankful that to date I'm not blind. Yeah, so it's very common, kids swallowing coins or like fall down. Yeah, food poisoning, very common in kids. Okay, so when your kids are young, also easier to get hospitalized like dengue fever, hand foot mouth disease. Yeah, so all this is like due to like weaker immunity and stuff. Okay, so what is needed to cater for these kind of things that can happen to toddler and teens? Usually to prevent like any those kind of big expenses, right? The parents should get personal accident insurance for the kid and a hospital insurance. So easily a stay in a private hospital, right, can easily add up to 10k per stay or more. Yeah, basically the medical inflation has been very high and it's really that high. So to minimize this kind of catastrophic expenses, right, basically you just pay like maybe 1k in premiums to get this hospital insurance with the rider and also like the personal accident insurance together, less than 1k, would minimize all these catastrophic expenses. So how it works for this kind is like reimbursement lah. So you must incur the expenses, then the insurance will reimburse you. So another thinking point about getting these plans, right, is that when these kind of accidents happen, you don't need to think twice about the medical costs. You just need to make sure your kid gets the right care lah. So because like usually when your kid fall down, you think like, hey, you need to go and see doctor or not. Yeah, that's a small cut, no need to see doctor nah. Yeah, but so with this insurance you already buy, right, you don't need to even think about it. Whatever the cost, the insurance will cover lah. So you just bring the kid to the doctor at the earliest time possible. Yep, so these two are very important. Okay, then moving on, as the kid grow up, then those kind of education from like primary school, secondary school, JC usually is not that high, so you don't need to like plan so much for it. But if you want to plan for it, definitely you can plan for it. Poly is more expensive than JC for sure. Yep. Then moving on, after poly or JC, then you want to move to university. So another big expense there. This is very important. So now currently I came from SMU lah. So SMU for 4 years of study, right, is 40 something K already. So in 20 years, right, it can actually go up to 80K. So this is some OCBC calculator that I use to calculate. So according to them, based on the rate of inflation and stuff, it will actually get up to 80K to study locally. Then private and overseas university will definitely add up to more. So unless your kid is very smart and can get a scholarship, then you don't need to plan for this expense. But you can't plan for your kid to be smart, right? You should plan for the worst, right? And hope for the best. Yeah, so this is how people usually plan for the worst, hope for the best. Okay, so anyway, if you really don't want to take care of your kids' uni expenses, you can ask them to take up a loan lah. Like, can you imagine letting your kid go through a 80K loan before they even start working is like quite stressful lah. So, but actually it's up to individuals. So if you really want your kid to take up their own loan, then yeah, go ahead. Okay, so just some statistics about children's CI. So CI means critical illness. So I tried to find the Singapore statistic, but apparently I can't find any. So we'll make do with the Hong Kong one. So according to the Hong Kong Children Diabetes Association, about 7 children are diagnosed with diabetes each month. So also in the last 10 years, the rate of children suffering from diabetes will grow 12 times. So it means that children are somehow developing these kind of illnesses at younger ages. And okay, by right, diabetes is not really a critical illness but it will cause like critical illness to happen more. Like it's more prone for them to get critical illness because like diabetes will lead to like need to chop off stuff or like heart attack, higher risk of stroke, that kind of thing. Yeah, so actually once you get diabetes, you are unable to purchase any critical illness cover lah. So this diabetes is actually one of the leading thing in Singapore. That is a big thing, as in like out of the many people you know, right, actually at least one has diabetes lah. You just don't know about that. Okay, so next is regarding cancer. So the Cancer Fund pointed out that cancer is the second killer of children over the age of 1. So it's second only to accidents and poisoning. So as you know lah, just now I mentioned accidents and poisoning. Accidents is very common in kids. So so cancer is now second lah. So if you want to protect your kids further, you should seriously consider critical illness cover. Okay. So according to the Hong Kong, yeah, they have 170 to 180 child cancer cases each year. Then fortunately, the cure rate is as high as 80%. Okay, so back when I was in secondary school, I had a junior who had cancer. He unfortunately passed away also. So it's not to say that you are young, you will not get cancer lah. You are young and healthy, you will not get cancer. Somehow cancer can just develop all of a sudden. Because cancer is basically just like uncontrollable growth of cells lah. So it leads to a lump, that kind of thing. So this can happen to anyone, no matter how healthy or whatever lah. So yep. Okay, another one is Kawasaki disease. So another story I like to share is someone who had a kid. So the kid, right, fortunately they got their kid all the necessary insurance before anything happened lah. So they bought the hospitalization, the CI, everything. And like I think on day like 20 something lah, the child was like diagnosed with hole in the heart. So it can be like not discovered in the womb lah, this kind of thing, but it can still only be discovered after that. So this kind of thing you really cannot plan for lah. You think in the womb everything is fine, but really come out you don't know what happened lah. Yeah. So these are the potential critical illness that happen to kids. And if like something happens to your kid, right, usually the parents will have to take time off to take care of the kids lah. So why you need this critical illness cover, right, is not to take care of the hospitalization bills, is to like replace the parents' income. So it's like, because parents when you take time off to take care of kids, then your income need to be replaced for you to lead the similar standard of life. So you think if like a kid fall ill and need, okay, let's just take diabetes as an example. So diabetes, right, you need to go for kidney dialysis, right? So you will definitely need to take time on to bring your kid for that lah. They cannot go by themselves, but they are still young. And then how much time do you need to take your time off? You need to think lor. So maybe if like 2-3 years until they are able to like become independent, then you can buy for 2-3 years lah. So you either buy on the mother or the father. So depending on who is the main caretaker. So depending on who is the main caretaker, then you buy based on their income. Yep. Then so like I mentioned, death, total permanent disability and critical illness coverage is normally for income protection lah, maintain the similar standard of living. Okay, so after you're a toddler and teen, right, you will grow up lah. So you become after you graduate from university, you become a young working adult. So when you're a young working adult, what you'll be thinking of is to give back to your parents. So this will form some of your income. If anything happens to you, whether they still need the income, if they still need the income, then you need to do some unanticipated death income protection lah, or any other kind of income protection. So just now I mentioned the income protection death related, total permanent disability related, and critical illness related. Okay. So according to statistics, 1 in 3 people experience critical illness in their lifetime. So critical illness can happen at any time, regardless of age. So it can be like totally fine today, and then next day you can find out you have a CI. Nobody knows this kind of thing. Yup. So I think what is most important when this kind of thing happens is always to make sure that you have a hospitalization insurance. Okay. So for Singaporeans and PR, usually you will definitely have your MediShield Life. So your MediShield Life will cover up to 150k per policy year. So in the event, okay, let's just take an example of like cancer. So like recently someone shared with me about some cancer stories lah. So the cancer treatment per year, right, is usually about 250k. This is like maybe for B1 class ward. So it's like if B1 class ward already costs like 250k, then definitely your MediShield Life will not be able to cover. So MediShield Life only cover for expenses based on B2 to C class ward. So any above 150k they do not cover, and also do not cover pre and post hospitalization. So pre and post hospitalization is before you discover that you have this illness, right? You go and see a doctor. So all this is not covered by MediShield Life. But when you get the hospitalization insurance, they will cover for a certain period pre and post. Okay. Yeah. Another catastrophic expense that you will probably need to cover is personal accident lah. So this one is based on like fate one lah. Don't know what will happen. Sometimes suay just bang into something or whatever lah. So these kind of expenses can be easily negated with personal accident insurance. So personal accident insurance usually very cheap, should be below $500 per year. Should be below $500. Minimally 100 plus. Yeah. So with this amount, then you just have a peace of mind. It's quite affordable lah, personal accident. Even if you can't afford hospitalization, you should still get personal accident lah. But hospitalization should be the basic lah, I feel. Basic hospitalization and personal accident before you move on to other things. Okay? So so people are afraid of like early forced retirement, so burdening others, especially parents. So why you buy this kind of thing, right, is obviously because you love someone. You love someone, that's why you don't want to burden them, that's why you want to do something for them. So this thing is a very intangible thing, so you cannot see and touch it, but it's about something. I mean, the thing is also about on love lah, so it's also something intangible. So like, yeah, so anything happen to you, your people still got money to help support you. In the event you have total permanent disability, then you can't even move or whatever, then there's a sum of money that come in that can help other people take care of you lah also. Yep. So what as a young working adult, you also will be thinking about how to make the most money. So how to make your money work hard for you lah. So you will be planning for like getting a house, because if you're single, you maybe at 35 you want to get a house. Okay, then even if you're single, you're a high income earner, then how to save on tax, you don't pay unnecessary tax, right? So these are the basics of financial planning lah for people that are single. Okay, so So about making your money work hard for you, I'll be sharing about some money saving tips. Won't claim to be the best, but yeah, we can have some money saving tips. Okay, so how you save money is always you go to the shop, right? You compare. I mean, it's a bit troublesome lah, but you need to go to the shop, then you go and look at the price, then you look at the item, then go Google lah. Go to Google and see whether it's cheaper to buy online or buy on the shop lor. So this is how you save money. Okay. Then also next time when you want to buy something, right, ask yourself whether you really need the product 3 times before you actually buy. So if you ask yourself 3 times and you actually say need, then you buy lah. Go ahead and buy, okay? Then another tip is to go out less. I mean, this is very anti-social, but it's really a money saving thing lah, because every time you go out, you will spend money. Right? Whether it's on food, transport, or entertainment, sure spend money. Right? Yeah. Okay, then another one is how to save money is use the appropriate credit cards and pay your bills on time. So the thing about people is some people don't even have credit cards, they only use their debit card. So you use your debit card, right, usually their rebates and whatever is very low, like miles or whatever. I don't even know whether they have miles, but usually it's all very low one. So you must get a credit card, and when getting a credit card, right, also always make sure you can get those kind of freebies like free Apple Watch or like free hairdryer, that kind of thing. Make sure you know all the deals before you actually apply for a credit card. Don't miss out on this kind of like money lah, because it's really, even if you sell it, you don't use the item, you sell it, right, you still can get money. So it's like few $100 extra, just maybe put in like 20 minutes of your time to do a bit of research for this kind of thing. So anyway, I also have a website that gives you this kind of information, so you can access it at the link here. I'll put the link down below later. Yeah. So also when you go out, always bring your own water bottle so you can save on buying drinks. It's also healthier. Yep. Then I realized recently a lot of people go for those kind of gym or those kind of classes like as a group one. So what you can do is skip this expensive gym and spin classes or whatever. Just do it yourself with YouTube. Everything can be done with YouTube. It's like free, right? Then you just, all you need is a mat, or you need the appropriate fitness stuff lah. So that thing, right, is like a set to you, but you keep spending on these like gym classes. So it's like buying a house versus renting. So you prefer buying a house or you prefer renting? So if you have an asset and then next time maybe you use already, right, you still can sell for money, right? So why not do it yourself and skip all these expensive gym and classes? I understand also got people go for like social reasons, but guess you can call your friends to your house and do it with them, or you all do it over Zoom. That's how you can save money. Okay, so another money saving tip is don't buy a car lah, take Grab and taxi. So it's cheaper. This one is a well-known fact that owning a car is definitely cost more than just taking Grab and taxi around. Yeah. Okay, another money saving tip is know your insurance stuff well. Also get a good insurance advisor lah, because good as in knowledge and heart lah. So you know that the person is not doubly like making you buy whatever you're not supposed to buy lah. So also like make sure you're adequately covered lor, to make sure that you cover all grounds. Okay. So in the case that you have this 99-cent Straits Times subscription, right, you can cancel it lah, because you actually can read all these premium articles for free with your library membership. So basically, all you need to do is go and activate your library membership. I think most people have a library membership. Just log in, and then after that, forever you can view these premium articles for free. Don't need to pay the $1 per month. Yeah, anyway, I don't think the articles are very useful sometimes, so don't need to pay for it lah. Yeah. Okay, then also knowing about your options lah. So your CPF OA can be used for your home purchase, your home loan insurance scheme. So home loan insurance scheme is something like you and your husband, right, or your other spouse, you all buy a house together. So there's this, I think it's you can pay this premium with your CPF. So the premium is like for, in the case that any of you all pass away, right, the whole home loan will be fully paid for. No need to care about home loan anymore. The whole home is yours now. Yeah, but so it's like reverse toto lah, okay. But it's not a good thing lah, but I mean, always good to pay this small amount from the CPF to get this kind of cover. Okay, so what your CPF OA can be used for also other like full-time undergraduate education at a public university. So you can repay it in 12 years. maximum. Yep, it can be used to invest in bonds, unit trust, ETF, or like those kind of investment plans also. You can also do a transfer to the special account to earn more interest. So lastly, the money saving tip is the 50-30-20 rule lah. So 50 is what you need, 30% is what you want, and then like 20% is what you save lah. So always have your financial goals and budget well on how to achieve them lah. So basically you need to first figure out what your financial goals in future. So you think all those people got rich without any planning? It's not true. They probably think of ways to like build their assets. So it's not about getting income. It's about building assets that can bring you income in future. So even like maybe now you need to spend more money, right? But if you're actually acquiring an asset, right, then it will definitely bring you to greater heights in future. But if you keep just earning your income and don't care about building assets, right, one day your income will stop because you will stop working. Then how are you going to get your income? You need to make sure you have assets, right? Yeah, okay, so that's the gist of rich people. Although I'm not rich yet, I'm trying to build some assets. Yeah, so that's how rich people work. Okay. Then after that, if you actually get a girlfriend or a boyfriend and you get married, so you have a spouse, right? So this is when income protection is even more important, because now, right, your income is not only used to support yourself and your parents. Now your income is used to support these few people plus your spouse and your children. So you have like more responsibility. And when you have this increased responsibility, right, don't you have a like obligation to protect this income to make sure that these people can live comfortably? Yeah. Okay. So talk about the usual thing that people need to plan for in their lives when they have a family. So first is housing. So housing, right, if you're talking about like BTO or like resale, right? So usually I'll just talk about BTO lah, because most couples just do a BTO. Okay, so for basic BTO is you can choose to pay a deposit of 10% or 20%, 25%, depending on whether you took a HDB or bank loan. So HDB is 10%. Bank loan you need to they pay a deposit of 25%. So 20% will be from your CPF or whatever. Then 5% must be in cash. Okay. Then you also need to cater an additional 5% for stamp duty and other miscellaneous fees. So you must make sure that you have this amount of cash before you actually buy a house. Yeah, then the remaining amount of money you can take out as loan. Okay. So this loan, right, if you go and use there's this HDB calculator, you can go and project how much you need to pay monthly. So if you see the amount you contribute into your OA, right, is more than the amount that you have to repay monthly, right, then basically you don't need to come out any cash when you buy a house. So you don't need to worry about cash. You only need to worry whether you are employed lah. So if you are not employed, then definitely you need to come out with all this in cash lah. Yeah. Okay, so then after you get a house, then after the house comes, right, then you need to go for renovation. So renovation is a minimum, I think very bare minimum, it's like $5,000 minimum. Yeah, because you buy like furniture, all this also, right? Cannot be like nothing, right? So renovation, I'm talking about like including furniture. I think minimally really 5k lah, yeah. Then maximum no limit lah. I mean, you can go crazy with the renovation. So I don't know. I mean, there are also average amount of each room how much you should be expecting to pay lah. You can go and check that out yourself. Okay, so make sure you have enough cash for renovation. Okay, then marriage. So I recently got married also, so I know all these expenses. For me, I think the minimum cash outlay, if you're talking about like 100 people, right, like all the pre-wedding or like 过大礼 or everything, right, minimally everything is 20k. Maximum no limit lah, obviously, because the rich people can go overseas for their wedding or whatever. Yeah, so that's for marriage. And basically there's also like those Facebook groups that can join that you can find out more about this kind of wedding stuff lah. If you're interested to know, you can let me know. I can invite you to the group. Okay. So the group is only for females, but if there's if you're a male you want to join, right, there's a Telegram group. I can invite you to the Telegram group. Yeah. Okay, then for kids, so if you're planning for kids, you need to make sure that you have this maternity insurance and education planning. So like just now I told you about the education planning is approximately 80k in like 20 years for university. Then maternity insurance planning is like when the kid is still in your stomach, you can actually, I mean not stomach, womb, you can actually buy the maternity insurance already. So it's to prevent like next time when the kid is born already, then you find out there are problems, then this insurance still can cover the kid. It's not to prevent it from happening, it's to prevent yourself from having to pay these catastrophic expenses. It's just to make your life better. So if you don't do this kind of planning and the kid born out with problems, GG, nothing you can do. Yeah, so always get this kind of maternity insurance planning before the kid is actually born. So another tip for parents is that there is a baby bonus. So for this, you need to go to the baby bonus website to apply. So before the kid is even born, you can apply already. So I think it's 2 months before you can apply, before the kid is due. So just Google baby bonus and then you can get extra money. So I think for the first and second kid it's $8,000, for third kid and subsequent kids is $10,000. So this will be given when all the money will be given when the kid hits 18 months old. Yep. So free money, please go and take. Okay. Then another next big ticket item is definitely a car. So most people when they have family and kids, right, they will always buy a car because it's really much more convenient to travel around rather than you book a Grab. Because if you maybe say have 3 kids, then you book a Grab, and then the Grab not enough to seat everyone, and you need to sit on each other or stuff. Okay, yeah, but so car average is about okay, I guess if you're buying a new one, but if you're buying a second-hand one, can go much lower. Yeah. So this is the amount of cash that you are supposed to plan for. Okay. Then another thing is also, as a young family, most people won't think about this early retirement planning. So why is this important? It's because next time in future, you don't want your kids to be burdened to support you, right? So you want to plan for your own retirement. So if you don't have any spare cash after paying for all your kids or your house, everything, right? I mean, just now I go through all this, I also feel very stressed because really have a lot of things to plan for. I mean, I plan for some of it already, but it's honestly a lot of expenses. So if you still have no spare cash, right, try your best to make some. Every little bit that you invest or whatever or put into savings, right, counts towards your retirement. So I know a lot of people think that the CPF is enough for retirement, but the truth is CPF is not enough for retirement. Because by the time you reach the retirement age, right, inflation is going to be, I mean, you know the power of compounding, so inflation will make that amount of money be very little. So a lot of people say 1 million is enough for retirement, but actually the fact is sometimes maybe 1 million is not even enough for your retirement. What if you live to 100 plus years old? Is 1 million enough? Definitely not enough, right? So it's about, so if you stop working at 65, right, imagine you live until 100 years old. That's 35 years. 1 million enough for 35 years of your expenses. And you must think, for example, I'm now just assume I'm 30 so 30 plus 35. How much 35 years of inflation? Will my CPF even be enough or not? I will tell you the simple answer, it's really not enough. You need to plan for more. Yeah. Okay, then as you are a young family, you move on to a mature family. So mature families are when your children have grown up and started working. So at that point of time, you will worry about being a burden to children because that's when the time most people catch get critical illness or anything, or they fall sick, or they just need more attention from their children in the physical sense. Yes. Okay. Then also worry about retirement. When am I going to retire? Whether I have enough money for retiring at the desired age. Okay. So also worry about health. So if you did not purchase any health insurance when you were young, right, you try to buy when you're old, right, the answer will be you will get exclusions. You either get exclusions or you cannot be offered the health insurance. So just as a background, if you have diabetes, they will not offer you any coverage anymore. So So if you buy before you get the diabetes, right, they will cover you for everything. After you buy, when you got diabetes, they don't even want to offer you the health insurance. So that's the thing lah. Yeah. So always buy early lah. So when you buy early, right, it's not about like getting coverage when it is early. It's about make sure that there's no exclusions in your plan and make sure that you even have a plan. So I know like a lot of people have like company plans and they think the company plans will cover them for life, but the fact is the coverage of company plans, right, at most I think is 70 years old. Yeah, so if you don't buy when you're young, right, then you buy when you're 70 years old. 70 years old might be the max age that you can buy even. So you buy at 70 years old, then by then if you got some病, right, got some illness, they will not even offer you. Yeah. Okay, so as a mature family, you also be worried about the stability of the investment. So when you're young, you will already do some investments, you will do more risky stuff like maybe crypto or like stocks. But when you're like maybe 60 years old and you're going to retire soon, right, then you'll worry about the stability lah. So you don't want to like have too much fluctuation. Later you retire in 5 years, then the market is down and then all your money will be, then you want to take out your money, then you need to worry about that lah. So maybe you will start thinking about how to form a stable stream of income that is guaranteed. So that's when people switch from the non-guaranteed to guaranteed income. Yep, so that's for retirement. Okay, so as a retiree, so imagine you're 65 years old and you retire already. So what you worry about is of course like living too long lah. Worry about children, grandchildren, that kind of thing. So some people will want to leave something for the next generation. So if you don't want to leave something for the next generation, it's up to you. So like some people, those rich one or like really care a lot about their kids then they want to leave a constant stream of income for their descendants. Yeah. Then also about whether the right people will receive the sum of money as planned lah, because sometimes you got hear a lot of like families, they fight over the wealth or whatever, over the tiny sum of money they also want to fight over lah. So better make sure all this will stuff is like sorted out lah. Yeah. So also when you retire, then you not deriving income, whether you should downgrade your plan to a public hospital or you still want to stay with a private hospital. So I just want to share one story that a taxi driver shared with me lah. So he had a heart bypass surgery at a public hospital. So his heart bypass surgery, so he told me he's like can tolerate pain a lot but to him, right, this heart bypass surgery, right, so how the heart bypass surgery works, right, is cut into your rib cage and take out your heart, then do something and then pull back your heart lah. So basically when you cut in the rib cage, of course it's like very pain lah. So he told me it's like super duper pain. He never ever want to go through this ever again lah. Yeah, so that's what happened to him. He did the heart bypass surgery. Okay, and after that I think he woke up and then after that he went to the toilet. Then I think he fainted or something. Yeah. Then like after the fainting, they find out like there's something wrong with him again lah, because there's apparently still have like water in his heart. So during the surgery, something went wrong and then there was still water in his heart. So if the water remains in his heart, right, he will eventually still will not survive lah. So but then this means that to remove the water in the heart, you need to perform the surgery again. You need to cut into the rib cage again, remove the heart again. Okay, so basically this is so painful that he didn't want to experience it a second time. His wife, only like maybe his wife and children keep saying, then he eventually agreed lah. So yeah, he went ahead with the second surgery to remove the water in his heart lah. Yeah. So and of course when I see him, he's still surviving lah. So yeah, he's still fine. So I think what he regretted was that he didn't continue with his hospital plan lah. So previously he had a hospital plan in a private hospital, but after that he stopped his plan because he had a brother that passed away due to an accident, but somehow the insurer, right, didn't want to pay the claim, so they had to engage into a lawsuit before they finally paid the claim. So yeah, the insurer still had to pay the claim. Of course need to pay the claim because the person died, right? Yeah, so anyway, the insurers did pay the claim, but because of this like lawsuit, he had a like bad experience with like insurance, so he decided to terminate his hospital plan. So the difference between the public and private hospital cost, right, will be public hospital maybe 100k and then private is 300k lah. So obviously if he doesn't have a plan, he doesn't have a choice whether to choose public or private, he will definitely go for the cheaper one. So he's like a bit regretful that he went for this public treatment lah, because he had to go through this excruciating operation twice. Yeah, but definitely 200k difference is very big lah. So if you can just get the hospital plan lah, then everything will be covered, and then you don't even need to choose private or private, you just go to private. And there's a really huge difference between private and public lah. So not saying that public is worse or anything, but I don't really think that. So he also blamed the hospital. He think that if he went to a private one, this thing will not happen. He will not have to perform the operation twice. So anyway, also the operation performed twice, right? And also he need to pay for the additional fees for the second operation, even though it was like he felt that it was a mistake on the hospital's part, but they didn't do any like follow-up suing or anything lah. So he just let it go lah. Yeah. So that's the story about private versus public hospital. So you determine whether you are okay with public. If you're okay with public, go ahead. And if you really cannot afford, then go for public. Okay. Just get the most basic public hospitalization insurance. Okay. Then if you really can afford and you really don't want this kind of thing to ever happen to you, right, please go for private. So you still have a choice whether to go for public or private in the end lah. Yeah, if you say like maybe the public hospital is nearer to your house, then you still can choose what. Like you go to public, then you think the public doctor cui, then you go to private. Yeah, at least have the choice that if you are rich enough. Okay, so I'll basically just talk about like prudent financial planning products. So what is it all about? Okay, just now I shared a bit about all this, but let me just do a more comprehensive sharing. Okay, so the basics of all this is you should start from hospital and accident. I say start from the reimbursement part first. So hospital and accident, right, there's no way that you can actually get more than the amount you incurred, because it's a reimbursement basis. So like for example, the hospital plan pay already, right, the accident plan will not pay. So actually the accident plan is the first payer lah. So accident plan will pay first, then the hospital plan pay. So there's no way that you can actually claim accident and hospital. No, it's only one, you can only claim one thing. So it's not really an overlap, but because there's things in like you are not hospitalized, then you need the accident plan to cover. So if say you fall down, then they wrap and bandage, you sprain your leg or whatever. So all this you definitely not hospitalized what. So but you when you see a doctor, definitely there will be charges. So this will be covered under accident plan. So for basic people, you really want to just don't buy anything, just get the hospital and accident plan. Yeah, very important. Okay. Then after that, when you want to do more planning and you love someone or you want to plan for someone else, that kind of thing, then you look at income protection. So for single people, right, usually you will still need to plan for critical illness lah. So as I mentioned, critical illness can strike anytime. So there are different types of critical illness: early, intermediate, severe, and recurring. So early is like maybe stage 1 of cancer, then severe maybe the last few stages lah. Okay. Then recurring means like for example, you have a heart attack, then you have another heart attack that's recurring. So as you know, if you already had one heart attack, it's more likely than not that you have another heart attack lah. So in most insurers, if you already had a heart attack, they will not let you buy a second product to cover your second heart attack. So what you buy is you just buy a product that cover recurring stuff or different kind of critical illness. So that's for recurring critical illness. Okay. Then we move on to disability income protection. So for disability, right, I'm just talking about single people lah, because we don't talk about death. Death later we will talk about it. So for single people, disability is also very important. Okay, so there are two types of disability, whether total permanent or partial. So total permanent disability, there are a few definitions. Later I'll explain the definitions. Okay, so when you have any kind of disability, you definitely need to protect your income lah, because you will not be able to work now. So if you not able to work, then somebody need to take care of you some more, then how can you not protect your income? So for this protection, usually people go for like 10 years, that kind of thing, 10 years of annual income for total permanent disability. And partial disability, usually people cover until the working age, which is 65 years old lah. So that's for partial and total permanent. Oh yeah, so for critical illness, why you need to protect your income, right, is because when you are sick, you have the critical illness, you are most likely unable to work. So when you are able to work, right, also even if you are able to work, right, you might not want to work also. You want to like take time off. You don't know when you can actually pass on, and when you still want to continue working, you still want to continue working. So you want to continue working, yes, okay, go ahead and continue working. But anyway, it's like if you can still continue work, you continue work. If you cannot work, then you have to protect this income lah. So you protect this income. Why? Is when you, because actually for critical illness, most people actually recover from it. So you need to cater time for your recovery, right? So like you got hear of stories of people getting cancer, then after that, because they went to like travel the world with all their money, right? Then after that they suddenly recover from the cancer, then suddenly got no money. So the thing is, you need to take time off work to recover from the illnesses lah. So usually people will plan for 3 to 5 years of their annual income that they take time off work, and so after they recover these 3 to 5 years, then they can go back to work. Yeah, so this is what critical illness is about. Okay, then lastly we talk about death lah. Okay, so death need to plan for whether it's too early lah. So if it's too early, then income protection for 10 years. So if you're something happens and you pass away too early, then definitely your spouse, kids, everything still need some money, right? Because from 2 people contributing to the income in a family become now only left 1, and the 1 person still need to take care of the children. Then without money is very hard lah. So it's like something like a consolation also, and like helping to make sure your family can survive this episode or that kind of thing. Okay, so death, another thing about planning is when it's too late lah. So too late is like retirement planning. So like most people will actually live until, in Singapore, the median age of people living until is 85 years old lah. So if you actually live until 100 years old, is considered a bit too late lah. So you need to plan for what happens if it really happens too late. So that's retirement planning. Okay, so all this is like financial planning. Okay, so for critical illness solutions, right, there are basically 3 types lah. Either it's an investment link or life or term. So what's the difference between all these 3 solutions? So basically everything can cover until 100 years old or more lah. So it's dependent on the product itself. So what's the difference? The premium payment is flexible for investment link after a certain period. So if your investment can generate enough money, then you can stop paying your premiums. Okay. Then life, limited pay, so you choose how long you want to pay lah. So usually insurers have terms of 10, 15, 20, that kind. Then for term, no matter what, you pay yearly lah. So usually they have this kind of renewable term insurance. Either you buy 5 years, so for the first 5 years it'll be very cheap, then next 5 years you'll renew at a premium, that kind of thing. Then you pay yearly until you pass away lor. Yup. Then for cash value, so cash value, there will be cash value for life and investment link. So for life, the cash value is guaranteed, and cash value for investment link is not guaranteed. It's based on investment. So term does not have cash value. So term does not have any cash value or bonus lah. So it's basically like renting a house, like just now I mentioned. So then so you just compare between investment link and life lah. So life is like owning something. Then investment link is like owning something plus investing lah. Yeah. Okay, so I just want to share about a real life rejection of a CI insurance application. So this is my own application. So I had when I was working in the other company, I had some health checkup. So I went for some health checkup. Then it was discovered that I had protein in my urine. Yeah, that was like 2 years ago. So somehow this caused my application for this plan to be rejected. So it's a real life case, it's my case that I was rejected. I am 27 years old only, I'm very young, but yeah, I can be rejected. So you think, everyone thinks that they can get insurance at any time lah, but the fact is you really can't lah. Yeah. Either you get exclusions or you totally get rejected. Yeah. Okay, so we'll move on to some definitions, simple insurance definitions for you guys to learn more. Okay, so definition of total permanent disability, the first definition, just now I said I will share more, right? Yeah, so first definition is either you lose both eyes or your hands above the wrist or your legs above the legs below the ankle. So any combination of these two that you lose, right, then maybe you lose like one eye or like one hand, right, then you will be considered as total permanent disability lah. Yeah. Okay, the second definition is can be caused by illness, disease or injury. So before 65 years old, you are not capable of carrying out any work, profession or occupation to obtain any wages. Okay, so this must continue uninterrupted for 6 consecutive months, so with no possibility of improvement for indefinite time. So as you can see, right, from this definition, total permanent disability is actually very strict, and it's very unfortunate if you actually qualify for this definition. But there are people who do qualify for this definition after like maybe some car crash, they really lose their limbs or whatever, then it will count as total permanent disability lah. Yep. Okay, so after 65 years old, what will count as total permanent disability is not being able to perform. For some insurers it's 2, some insurers it's 3, so it depends on the plan that you buy, so you better check. So it's at least 2 or 3 out of the 6 activities of daily living. So activities of daily living are stated here. Yeah, if you're interested to know, you can just pause and take a look. Yes. Okay, so some of the objections that I've gotten for my clients, I just want to share, and then I want to share why these are not like valid objections. So they will always say, oh, I'm fully covered by my company, my parents will buy for me, the army already cover me. Okay, sure. Okay, so acknowledge you're already fully covered. That's very good that your company, parents or whoever all buy stuff for you. Okay, so for the company or the army lah, so are you going to stay with your company and army forever? Even so, if you're staying for them forever, if you're not, right, then already gone lah, this reason not valid, right? Okay, so if you're going to stay with them forever, then group plans only last until 70 years old maximum lah for most insurers. So after 70 years old, you want to buy plan, you just cannot buy lah, telling you cannot buy anything already. 20 years old, I think that's the max age for most insurance plans. Yeah. Okay, then only plan that you don't need to buy that if you're already covered, right, is probably the personal accident plan or the partial disability income protection plan. So for this, if your company already buy for you, right, then it's no need to buy lah. But if the other things your company buy for you, you still need to buy, because like I mentioned, there might be exclusions and in future you might not be offerable at all. Okay, so if your parents already buy for you, okay, that's good. Do you know what is already covered and whether it's sufficient with your current income and stuff? Because I talk about income protection is based on your current income. When your parents buy for you, it was young, and then maybe they just buy a nominal amount, so might not be sufficient. So you need to take a look whether it's sufficient. Okay, so when is a review usually required with your insurance agent is when there are income changes, life stage changes. So life stage changes are defined as like marriage, kids being born and adopted, or death of someone close. Okay, so death of someone close, maybe the person was supporting you or whatever, so now you need to get more stuff lah, that kind of thing. Okay, so another one that people always say, oh, I'm still young and healthy, I don't believe in insurance. Okay, fine, you are young and healthy, that's good, very good, right? Okay, so when you're young and healthy, that's when you can actually buy. So when you are young, you are old and not healthy, you can't even buy. Okay, so precisely why you need now, and premiums only get more expensive when you get older. So some people, like say, can't buy anymore lah. There are people my age that actually have diabetes, can't buy anymore. Okay, then as you age, definitely more exclusions lah. You can't get more healthy. I mean, you technically can get more healthy, but even if you get more healthy and there's a record of you being unhealthy, right, it still can be possibly excluded from your insurance. Yeah, so more exclusion as you age. So you get diagnosed where you every time go for checkup, right? Then you wait till you are old, then you buy, right? Then all these conditions all show up. Then they have to be declared in your insurance application. So it will result in exclusion or rejection. Yeah, so if you don't believe in insurance, what do you believe in? So you believe that accident, sickness or death will never happen to you within the next few years, ever? There's not even a slight chance of this happening. Yeah, okay, so there are people with my age or younger already have diabetes, schizophrenia, cancer, all these. How can you predict when it will happen? You cannot predict, right? You cannot predict, you better go and find some way to negate this kind of risk. If you don't want to negate this kind of risk, you then well make sure you have a lot of money. So let's say your net worth is 10 million, right? So say right, somehow tomorrow you get cancer, okay? So if you are so rich, right, usually you will want to stay in the private hospital, right? So you pay private hospital, then you pay for all your cancer treatment. Okay, normal you stay at government ward maybe 250k per year lah. So if you stay in private, maybe double or triple. So double or triple, 500k, 600k, 900k, I don't know. Okay, within 10 years, your net worth still 10 million? Don't think so lah. So why would you want to do that with your money? You should just pay a small amount of premium to get rid of all these risks. The insurer bear all the risks. Just pay a small amount and then your wealth will not deplete. Just deplete by only that tiny amount. Does it matter to you that tiny amount? Why you want to take the risk and go like all by yourself? Yeah, so that's my opinion lah. Okay. Yeah, but so after all that I see, if you still want to go on your own, go ahead, to each his own. Okay. So another rejection that I get is it's too expensive, I have no money. Okay, so if your money is very tight, at least get the basic hospital and accident plan lah, like I mentioned, and also basic income protection term plan. So these basic income protection term plans are very short lah, so 5 to 10 years renewable, and it will be very cheap because if you are currently quite young, it will not be too expensive one. Yeah, it's the cheapest insurance you can get at your current age for term plans. Okay. So if you don't know whether you can afford it, so sit down with your advisor so you can give your cash flow analysis. So the cash flow analysis, if really after the cash flow analysis you really cannot afford it, then no choice lah. But you see, if you have no money to afford it, that means you cannot afford to fall sick and die also. So that case is also very important to still get covered. So if you can die, just squeeze out some amount for this lah. Yeah. So if something unfortunate really happens, like maybe say in a few days, will you regret saying that you had no money to buy this? If you will regret, then you better make money to buy this lah. Yeah. Okay, so another objection that I receive is let me consult my parents, friends or spouse. Okay, sure, you can consult them, but anyway, just let me tell you about this story. So like, say if there is an experienced doctor, he does a checkup on you, and then he also have to do many other blood tests or x-ray lah. So tell you that you have lung cancer, but then all your friends, parents and spouse also say fake one lah, you only have the common cough. Okay, so which one will you believe? Of course your friends, parents or spouse are not trying to harm you lah, they just want you to feel better and tell you that you have the common cough. So they are not trying to harm you, but they just don't know your situation well enough and don't know any better lah. So like if we had a conversation and then we just spend the entire 1 hour talking about your needs, right? Are your needs going to be the same as them? If it's not going to be the same as them, what's the point of consulting them? I mean, sure, you can consult lah, and we can do the consultation together, so I can like answer their questions together. So like, for example, you are unable to answer their questions, I can answer their questions, so you don't like communicate wrong stuff to them lah. Yep. Okay, so just share a bit more about the inflation rate in Singapore. So it's about 3%. Okay, so is this the full picture of inflation rate in Singapore? So the answer is no lah. So inflation experience can be different depending on what goods and services is purchased by individual. Okay, so some of the other inflation figures, okay, so like housing is about 4%, medical is about 15%, education is 13%. So like all this you can see is all these are what people consume a lot lah. Then if this is like inflation is so high, right, how can you keep your money in the bank and only earn like 0.05% interest? Your money will be like lesser and lesser all the time. It's not even like interest, it's like less and less spending power lah. Okay, just one example I want to let you know. Last time you buy an orange, right? I think only cost 65 cents. Now it's like, okay, so this NTUC offer is actually $6.45 for 6 orange. So one orange, right, costs $1 plus now. Do you know that? Yeah. So inflation is very real. It's like double the price of the original orange already. Okay, so yep. Okay, another example, let you know about compounding interest. So if you never knew what was compounding interest, let me explain to you. So if you start with like $100, right, you put in a bank. It's an example, the bank gives 6%. I know in Singapore no bank gives 6%, so just this example, the bank will give you $6 at the end of the year. So on the second year, you never put any new money inside. So it's the total bank balance will be 106. So 106, right, they will compound the 6% on the 106. So this year you will get $6.36 instead. Then the third year you'll get more, you get more and more. So this is the power of compounding interest. So the power of compounding interest only works best at the last few years. So like if you save only for like 10 years, right, the power of compounding interest is not going to be much lah. But let's say you save for like 30-40 years, then the compounding interest will be quite substantial. Okay, so also there's this theory, the number of 72 divided by the rate of return is the amount of time that your investment takes to double. So it's like if you save at like 1%, then you'll take 72 years to double your money lah. But let's say you save at 10%, then you only take 7.2 years to double your money. So in between, you just divide, use the formula accordingly. Yep. Okay, I'll just share a bit more about investing also. Like, yeah, so imagine there's like two people, like A and B. So one guy, he starts investing at like 19 years old. He invests $2,000 per year from the age 19 to 25. Then he stops thereafter. So total, he only put in 14k into the stock market. So this other guy, right, he only start when B stops. So like from 26 until 65, he invests 2k annually into the stock market. So total, he invests like 80k into the stock market. So assuming both investors, right, they can generate at 10% yearly, who would you think has more money at 65 years old? So everyone look at this example, they will obviously think that the person who invests more will have more, right? But no, the answer is actually B will have more because of the power of compounding interest. So like you can see, the investor A, which is the guy who invested later, right, has only 893k, whereas the other guy has 930k. Okay, so the moral of the story is always start investing and saving early. So time is like your greatest asset rather than how much you actually have. So even if you have very little money, just make sure you start investing and saving early lor. Yeah, every dollar or cent counts lah. Yep. Okay, so a bit more about the types of saving and investments. So they are ranked in increasing risk appetite order. Okay, so lowest risk, of course, is the cash, bank, and fixed deposits lah. And also they generate the least interest lah. So as you know, low risk then low interest rate lah. Yeah. The higher your risk, then probably more returns lah. Yeah, high risk, high returns, you know, right? Okay. So for bonds, also like all these are usually low risk, depending on what bonds are. There are also like junk bonds which are not rated, that kind. So could actually be high risk. Okay. So usually then endowment, annuity plans. So this usually you can buy from insurers. Okay. Then real estate investment trust and property. These are not so high risk also, so you can buy these from the stock market. And property everyone know where to buy from lah. Yep. Okay. Then after that is real estate. Exchange traded funds, mutual funds, index funds. So all these are plans that they are funds that are like diversified. So they have a basket of either stocks or bonds, or they have like some kind of options mixed inside everything, right? So all these are already diversified, so their risks are not so high. Yeah, but if you compare to like stocks, commodities, call and put options by itself, right, then the risk is very high lah. Okay, then the highest risk and the highest return is definitely cryptocurrencies lah. You can see like more than 30-40% dropping in one day, and it can also go up more at 30-40% in one day lah. So cryptocurrencies is insane. I don't know whether to even call them investments, because technically I don't know whether they can ever go to zero. Like, yeah, so you treat it like something like additional lah, like Toto like that. Yeah, I know some people don't have that opinion because they think that cryptocurrency is going to one day take over the world as real money, as in it has real money value at the moment, but whether it will take over as like the legal tender, that's a question mark lah. But that people who buy cryptocurrencies and they don't think that it's risky, right? They have this opinion that it will eventually become the legal tender. That's why they believe so much in it lah. Yeah, but if you are not sure about it, then I suggest you stay away from it. Yep. Okay, so I'll just speak a bit about long-term investing. So as you know, for like investing, right, if you are looking at a 1 year kind of thing, you can possibly gain or lose 40%. But if you're looking at a 20-year thing, right, most likely you will be earning lah. So you even at a low rate, right, you still earn about 5%. Yep. So even though investment is like non-guaranteed, if you do long-term investing, it is in a sense guaranteed lah, based on past data. But as you know, past data doesn't represent the future lah, so you make your own judgment. Okay, so just now I talked about retirees and estate planning, right? So just sharing a bit more about it. So do you know what happens if someone passes away without a will? Okay, so if you don't know, you better go and read up on it, but I can tell you a bit more about it. So your estate will be distributed through this thingy called the Interstate Succession Act. So it's based on like how many family members are left, then like if who is left, and how to distribute lah. So it's according to the law. So it's like no choice lah, because you didn't have a will. Okay, so for this, right, it is a slower administrative time to distribute all the assets. The assets all will be frozen first. Yep. So it will eventually take about 1 year to carry out this entire distribution. Okay. Then there will be fees involved also lah. So like maybe $10,000 around that. Yep. So also complications may arise while distributing the assets lah. Yeah, so best to always have a will. So if you have a will, there also assets will be frozen. So it will be frozen for like 3 to 6 months. So it will take 3 to 6 months to finish all the admin stuff or the will. Then fees for handling the will be lower, also maybe about 3 to 4K. So this is in accordance to the wishes of the deceased. Yep. So it's able to distribute assets more precisely and evenly. Okay, so many things that people don't know about this kind of distribution is whether like if like you have nomination of your CPF or your insurance, right, which one will overtake which one lah. Okay, I'm here to tell you that nomination always overrides the will or interstate succession. So in the event that you have an insurance policy, make sure you do all your nomination properly. Yeah, so it's not affected by all the will or interstate succession. So it means like once the person pass away, if they nominate somewhere, the person can take the money immediately. You don't need to care what is written in the will because it's not valid. Yeah, same for the CPF. Okay, the rest not so important. Trust, all this. If you're interested to find out more, right, actually there's a lawyer firm that you can contact. It's a free consultation. If you're interested to know, I'll put down the lawyer contact below. Yep. Okay, so like the government has been recently thinking about how many people do not have a will and stuff, so they also come up with this website called mylegacy.gov.sg. So it's about planning for the end of life. So it helps you to explore what's going on, that kind of thing, and share your end of life plan. So it's about protecting what matters to you lah. Yeah, so with all this sharing, I would like to just end with saying this. So the best time to start financial planning is now. Yesterday is gone. Tomorrow, we don't know. And now is all you have. Okay? So many great things are also undone because someone wanted to think about them rather than do them. So also like, I know this financial planning is a very heavy topic. Then without like ironing out your mental health or whatever, right? Nobody in the right mind will sit down and think about all this heavy stuff. Yeah, but eventually you have to do it. And the best time to start is now lah. If not, you're going to procrastinate until don't know when lah. Yeah. Okay, that's the end of it. Before I end this video, I just want to disclaim that this video is purely for educational purposes. The information contained is should be accurate at the time of this video being launched. Yeah, so that's the end of it. Thank you for watching this long video. Hope you learned something through this. Yep. That's all for today. Bye bye.